Good morning, everyone. Happy Friday. Thank you so much for joining us. I'm Mark Gambita.
And Tim Lipowski here. We're also joined by Mackenzie Bento, who's from the Main Street team. She's helping us with the presentation and just making sure everything runs smoothly. Thank you to Mackenzie.
Yeah, thank you very much for joining us today, everyone, especially on a Friday. We appreciate you pulling up together to hear what we have to say. Today, we're going to discuss the recent Trump tariffs, how they affected the market, and how we should be thinking and operating moving forward.
Yeah. So thank you all for coming. We hope to make these things a little bit more regular. Obviously, wild times we're going through. So hope you guys find this worth your time.
Feel free to try to grab or snip any information if you think you need it, but assuming we are successful with Mackenzie helping us record it, we also intend to send the presentation out after. In some instances in the future, we might only record the audio, but here we're going to show you a lot of information and material on the slides. So we figured it would be helpful to have the whole entire thing recorded so you can reference the slides, charts, graphs that we'll be showing you. As I'm sure everyone's aware at this point, on Wednesday, April 2nd, the Trump administration implemented sweeping tariffs. These tariffs were set to go in effect 1 week later, this past Wednesday, April 9th at 12:01 a.m. in the morning. The big question here is, will countries negotiate or retaliate? The Trump administration themselves said that there would be short-term pain in the markets as negotiations take place over the next couple months. To be fair, this is generally what Trump campaigned on. There's consistent messaging from him going all the way back to the 80s and, recorded clips of him talking about negotiating on this behalf. From President Trump's perspective, these are bilateral negotiations, meaning they have a lot more to lose than we do. He said the tariffs are going to be put in place to restore the US to manufacturing, competitiveness, and trade. Now, we're not going to spend a lot of time debating the merits of that, but rather we'll take a look at the facts and what unfolded and what we think we should be doing looking forward. The tariffs put in place affected approximately 90 countries, and some of those tariffs ranged well over 40%. A universal baseline rate of 10% was also affected across the board. This baseline rate was likely to prevent product circumvention. So think, trying to reroute products through Mexico, Canada, or some other country with a lower tariff rate. On April 9th, during the day, more than 75 countries came to the table, and the administration moved to pause all these higher punitive tariffs, minus China, and they moved all of them back down to 10%, which is being collected now for a 90-day period. This period would allow for negotiations. China's a different story. At this point, the two countries keep going back and forth, continuously raising tariffs. Last I saw, US is at 145% on China. I believe as of this morning, they raised it to 125% to us. On this announcement, the market soared. Keep that in mind. Tim's next point will be to talk on some of that. A really important note here on tariffs is the US is actually the second freest trading system in the world. Japan's number one. Sure, there's definitely problems out there that should be addressed, in our opinion, from a trade perspective. But, at the same time, I think everyone here could maybe broadly agree, but we're not particularly fond of the shotgun method. Part of the challenge here is going to be, will countries commit or will they sit back and wait? The same story is going to go for US and international companies as well. Do you ultimately pick up a factory overseas and relocate it here if the policy doesn't stick? It's paused, it's changed, or it simply is repealed a handful of years later? Of course, President Trump is on his second term, and therefore he has 4 years remaining. So, ultimately, next administration can back these up, or they can change them moving forward. Uncertainty is the kryptonite of the markets, right? So when we look at what actually affects the markets the most, outside of maybe poor earnings performance and things like that, the number one thing that's going to cause up and downward movements in a short period of time is uncertainty. These tariffs that were implemented were higher, faster, swifter, in reality, just crazier than anyone anticipated or expected. Part of the confusion here is when you listen to different parties from the administration talk on this, sometimes they're saying it's trade unfairness, other times restoring the middle class or manufacturing capabilities in case of war, border security, unhappiness with fentanyl. There's a ton of different things coming out as to why we might be putting these in place. In our opinion, it's probably best to just tune out all those reasons. In the grand scheme of things, Trump is placing himself as the shot caller here, and he's the only one that's ultimately going to make the final decision on how we proceed. Tariffs can be used to accomplish three different things, but they all contradict each other, right? You can't have all three of these things at once, but rather you have to focus and narrow on why you're putting them in place. We can use them to generate extra revenues. We can use them to get trade concessions or better deals and with trading countries and partners. We can also use them to protect certain industries of national interest. Think steel, energy, industrial, semiconductors. Yeah, we might be able to get these items for cheaper outside the US, but I think most of us can probably agree it's in our best interest to be able to also produce them here. All in all, if we can read through the tea leaves correctly, it seems to us that the Trump administration is placing these tax cuts to try to create wiggle room for the Trump tax cut extensions. During his first term, President Trump placed a tax cut that ultimately is set to sunset in 2026. Ultimately, if these tax cuts aren't extended, we could all be looking at higher federal taxes in the forthcoming years. We expect to hear more about the tax cuts. The conversations have really just started to hit the newswire, of course, pretty largely drowned out by tariffs and all the other madness in the very short period of time recently. But we think we're probably going to hear a lot more of this through the end of this quarter, the beginning of the next quarter. As we do get into the 2026 year, midterm elections start. A lot of focus is going to go into that. And shortly after midterms, we enter the lame duck period for the president. As we get to that point, it makes it more and more difficult to really get anything accomplished. We think this is part of the reason that the Trump administration is moving so fast and swift. They want to try to get in front of this and get, whatever agenda they might be trying to put forward in motion as quick as possible to avoid getting locked as they get further into the term. What does this mean ultimately? More short-term volatility. Can't say the coast is clear. Both ups and downs, and we expect to see that in the near future until we get further clarification. You can see here a list of both headwinds and tailwinds. Think of a plane. Tailwinds are going to push the plane forward easier. Headwinds are going to stand against it and restrict it from moving forward. Not going to spend too much time reading every single line item here. You can take a look at it for yourselves. But what I will say is, after covering some of the bad just now, we do have a lot of tailwinds going for us. At this point, consumer spending remains strong. Keep in mind that's about 70% of overall GDP. The job market remains healthy. Unemployment ticked up ever so slightly to 4.2%, but on a historical measure, 4.2% unemployment is world class. It's an A+. It's absolutely amazing. Up until the last couple of days, we'll see how this looks going forward. GDP remains steady and looked very good. We're getting growth slowly but surely, but that's also what you expect from a developed economy. Corporate earnings strength has been amazing. Keep in mind, today is the kickoff and the start of Q1 earnings. So you have the big banks like JP Morgan, Morgan Stanley, and some others just starting the new cycle today. In previous reports, corporate earnings, reinvestment in productivity, employees, machinery, technology was so strong that in fact, price to earnings multiples were trading high, right? So the value that you would pay for a company was more than maybe it would be today because of the fact that they were on such a good pace. We also have the Fed's monetary policy in our back pocket as the ace in the hole. A lot of clients and just people in general are saying, why isn't the Fed moving rates down faster? Why aren't they doing more cuts? Why aren't we enacting an easier time for the US economy? That sounds great and all, but those silver bullets that the Fed reserved are imperatively important to help transition through rough times. So if we do continue to see a rough patch, we do ultimately have the Fed with quite a few interest rate cuts that they can still put in place to try to make things cheaper for companies, for people buying and selling a home or starting a business or any other transaction they might try to enact. Ultimately, given the reaction to the investment markets, we view this a lot more as a political error, not exactly an economic problem. Although we're digesting the information as it comes out, keep in mind a political error can become an economic problem.
Yeah, so last week, I'm sure all of you looked at your accounts and were, unhappy and shocked at what you saw. We've been through downturns in the market before, but if this one felt different, it's because it was. Only 3 times in history has there, or not in history, in the last 75 years, has there been a worse 2-day stretch in the S&P. So you'll see these spikes here, the 3 that lead up to April 2025. Those are the 3 worst prior days, and last week, Thursday and Friday, were the fourth. What you will notice when you see those spikes downward is they're pretty immediately followed by big spikes upward before things ultimately fall into place. So all this is to say that Thursday and Friday were shocking, and if they felt heavy, it's because they were. But shoe on the other foot, similar to what we saw this past Wednesday, there do tend to be big spikes. So something to keep an eye on. Like I just alluded to, and we by no means are kind of through the woods here yet, but Wednesday, we saw the second greatest day in the history of the NASDAQ, the second highest day in history. That was based off of the news that, the tariffs were going to hit a 90-day pause. And you can just see how fast that leads to a turnaround. Some positive news came out, the market skyrocketed fast. So, where that last chart showed, the biggest dips, and while Thursday and Friday were historically bad, we have historically good days, and it's those good days that are so important and really go a long way to illustrate, why you stay invested. And that's a lot of what I'll touch on coming up. So what you're looking at here is from 1980 to 2025. This is the blue graph or the blue bar is representing the market's total performance for that year. The orange or yellow bars are representing intra-year downturns during that same calendar year. So what you can see here is that there are very many years, pretty much every year, where there are negative downturns in the market that ultimately lead to high returns for the year in total. If we look back as recently as COVID, we hit negative 34 in 2020 to ultimately achieve positive 16%. Then if you even go back to the last couple of years, we in 23 and 24, which we all think of as fantastic years in the market, and it's because they were. But what you'll see there is we did hit 10% and 8% downturns to ultimately hit 24 and 23% returns. So again, not to beat a dead horse here, but, downturns like this or downturns in general are not as uncommon as you'd think. I think a lot of times we, as the investor or the consumer, look at the end result and we think, oh, things were great. And we forget about what had happened that led to that point. Point being that downturns, while this one might be severe, we've been through downturns like this before. You can just look at that orange graph and see the big pulls downward, right? But then also look at where the market finished. So with all those, spikes high and low, something that we become, I think, accustomed to in our day and age is that, each new headline represents an end of the world scenario. Every headline's different. And, it hits people differently for, their own personal reasons. It hits people differently for, monetary reasons. It's different to everybody. So we can't just say blanketly that, headlines are, should just be totally, disregarded, right? Because they mean different things to everybody. But what we can show is that we have a pretty long history of pretty, severe and shocking negative headlines. So what we're looking at in this page here is from 95 through 2024, and I'm not going to run through all of these, but these are the major, negative headlines that we, faced through the years. And some of these have led to negative returns in the market. Some of these have led to global pandemics, so it's not to be discounted because these headlines have sweeping ramifications across areas outside of the stock market. The point is that there's never a shortage of a bad headline. And something we hear all the time is, well, this is different. This is different because this is different because that. Don't want to discount anything, but when we look at it, these are a lot of pretty negative reports. And I think the general idea here is we want to keep the headlines, out of your long-term vision for your portfolio, because if you get caught in it, as we can show, things can get more messy. So never going to be a shortage of negative headlines. It can be tough. It can be difficult to try to, keep that in the rear view. But that's where we believe you should be. So given those negative headlines, again, how did the market perform? So this is going to show you here, if we go back to 1970 on the far left, all the way to 2025 on the far right, if we started with $10,000, given all these headlines in between, how would that $10,000 have reacted if you just left it there and you never touched it? As you can see, obviously it's grown tremendously over time. That would be at on that far right button. But what you can see in between is all of those negative headlines that were just on the prior page. Those happened in between. And you'll see that it doesn't, work linear. There are years that are big swings up, there are big swings downward. But you can just tell that compounding over time, just leaving that there, if you're getting that annual S&P average of 10.8, that shows just the strength of staying put. And it can be difficult because a lot of times our dollar is, our dollar is tied to our emotions. It's tied to our lifestyle. Things like that are very real and we cannot discount. So, the idea of just setting things and forgetting them, I don't think is what we're trying to say here. I think if you have concerns, if you have issues, we want to be the ones to chat with you. And for some people, whatever is right for them at that time, that's personal to them. But we are confident that over time, and as you'll see in these marks and these graphs and charts, that that is historically shown to be the right move to stay put. So again, hammering this home here, but volatility is a part of investing in the stock market. We just talked about that annual, on average, 10.8% return, right? So if you're going to receive that 10% approximate annual return over time, what do you have to put up with? And again, like I'd shown a few slides ago, these pullbacks are more common than most people even realize. You see that it's on average, you get 3 corrections of 5% per year. We don't feel that because when things aren't dropping drastically, we're not, racing to check out our account. We get 1 correction on average of 10% per year. We get 1 correction of greater than 15% every 3 years. And even every 6 years, we get a correction of greater than 20%. So all of those things, add up to that 10% approximate annualized average return. The S&P, if there's baseball fans, have a batting average of 75%, meaning positive years since 1936. It's a pretty good batting average over time. So, that not to say that there aren't years that are big swings upward and minimal years, upward and all in between. But you have to tolerate these things in order to achieve that average. If you start hopping in and out of the market, that's when you expose yourself to more risk than should be necessary.
This chart illustrates both the bull or positive 20% years and bear or negative 20% years. Anyone who's talked to me probably knows this is my favorite chart in the financial markets. Pretty simply, the market itself is made up of periods of boom and bust, right? The most important thing to realize here to me is on average, when the market declines, it lasts about 11.1 months. So, there's nothing that says we can't go down further from here. We can't enter some type of, some type of bear or recessionary period. That's certainly a possibility. But really important to know is they don't last forever. If you look at the periods in which the bear markets and upward markets trend, they tend to be significantly longer. And to the point of the, S&P 500 chart, $10,000 becoming $2.8 million over 50, 55 years. I get it. We might not all be alive 55 more years, but most of us have that time or pretty close to it. It's a good amount of time overall that we can be exposed to the market. This is where financial planning really comes into play in cash flow management, right? If we have enough cash, money market, CDs, short term bonds, or other types of fixed income that can help us complete our goals and spending over that approximate 12-month period, we really shouldn't be worried about temporary depression in the equity market because ultimately, when it does turn around, it tends to go up big. As of right now, the US markets are up 40, 50, 60%, just depending on fluctuation in the last couple of days. But you can see that the average bull market, in fact, rises closer to 150%. Now, to be fair, these are averages. Some are a lot more, some are much less. But even on the downtrend side, you tend to see that it's not forever, right? It's not that the market never ever turns around and we can never return to normal life, but rather we need to make sure that we have ample spending, whether that's through your income, social security, again, cash, money market, fixed income on the side, that if we do enter a downtrend period, we have options to be able to withdraw money from, right? If we look at the end of last year, we're coming off of a 27% and then 24% stock market year, and you need to take some monies out of your account. Well, equities just went up a whole ton. It might not be a terrible place to pull from. If we're looking at today and you need to take some monies out, realistically, equities are down, and that's where we want to go to bond. And that really, is the importance of diversification. To those of you who are, a lot younger and you have 30 years to retirement, don't worry, right? There's a lot of time left in this. And as we're showing you, average downtrends tend to last, not much more than a year. It can definitely feel unnerving, but as we illustrated earlier, a lot of the best days in history often follow the worst. You can see the scatter plot here of worst days and best days, and many of both the up and down spikes have some level of retracement one way or the other. We tend to hear from clients, "Hey, can we miss some of those worst days?" Last couple, there were quite a few, but there was that 12% day in the NASDAQ. Ultimately, if you stay the course and stay fully invested, you'll get very strong returns over the long run. If we magically figure out how to miss downtrend markets, yes, you could receive an increased return, but probability lies that you need to call the exit and sale correctly, plus the purchase back in. If you don't do that successfully and you miss a handful of good days, it can be eviscerating to your portfolio. One question or point we keep hearing or do hear around these times is, what if I just sell out now? I wait till the dust settles, things look good, and then I reinvest? Well, again, we just had a historically second best day ever on the NASDAQ. If we sold out beforehand and missed that day, you can see what missing 5, 10, and more of the best days in the market as they proceed forward can do to your portfolio. By simply missing the best 5 days, hypothetically sell out towards the end of last week as the market's looking very bad, try to stay out for a couple months. As we showed you, a lot of the best days follow the worst days. You could be cutting your total long-term returns by a third. Percentage-wise, maybe something, but even dollar-wise could hurt a lot more. Historically, the market is made up by really strong boom years and some poor years, as I mentioned earlier. If you take a look at the last just under 198 or so years, less than 7% probability happens that we actually hit a recessionary period. So can it happen? Yes, it is always a possibility. At the same time, you're much more likely to hit moderate to really good years in the market overall. And part of what we're preaching to is you need to accept that at times there are bad years in between in order to get those strong returns in the other years. An interesting point from our side, you look at the last 2 years where market did really well. We consistently hear the analysts saying it's going to be an average year. We're going to get a 5 to 7% return. Probability wise, that is super infrequent. They'd be much better guessing we're going to get a 22% return, because more often than not, that's what tends to happen is very strong returns in more and more years. And strong performance can and usually does follow strong performance. Up until, again, the recent tariff announcement, that's the view that we were taking. It looked like we could be adding more strong performance on top of 2 other years. But the experts say there's going to be a recession. This time is different, unlike the other 30 or 40 we just laid out in front of you. Well, it could be. Again, we don't have the perfect answers to this. And as pretty much all of my clients know, I always say if I did, I'd be on a beach drinking a Corona and hanging out with my baby and not working a day job. Nobody has the perfect answers, and anybody who tells you that they know what's going to happen with the market is guessing, and you probably should consider taking your own guess. Let's take a look at how the analysts and experts did with their recent interest rate predictions. As you can see here, Wall Street analysts did a decent amount worse than a coin flip. It'd probably be more worth your time to either just guess yes or no, and you would have a higher probability of being right. As Yogi Berra says, it's tough to make predictions, especially about the future.
So key takeaways here. What does this all mean? Where do we stand right now? Our belief is that uncertainty is still the name of the game. We believe that the uncertainty around the tariffs is a bigger risk than the tariffs themselves. We saw on Wednesday how fast things can rebound and go sharply upward. But the reason for that was a 90-day pause. That was not a total victory for us or anything like that. It was a pause. Here's where things stand. It's not anything more than that. So we are at a point where there still is uncertainty. There's some breathing room. We can take a deep breath, but we still don't know how this is going to shake out. So our view is that while the risk of an economic recession has increased, we don't think that that is the base case at this point. So we do believe that markets are going to remain extremely volatile, downside and upside, as we've seen both recently. We believe things like market multiples, like price to earnings, could continue to fall and could continue to lower, and that can, of course, be concerning. And those are things that we're keeping our eyes on as this progresses. By no means do we know which way this thing's going to go in the short term. We would love for this to be resolved, as quickly as possible. But that's not our reality right now. So it's a moving target. We're monitoring things as they're moving forward. Again, we don't think that a recession is a given at this point. Our economy does have growing earnings, as Mark had alluded to, and those are some things to be positive to look out for. And as we stated earlier, that's not our base case is a recession. Our belief right now is that a stagflationary environment could increase. The odds there could be the end result here. But again, it's a moving target. We're in a state of uncertainty. So, what do you do as a result of that? How do you try to best protect yourself? We believe that diversification and diversifying within your portfolio is imperative in all of the time, but especially in times like this. Tariffs have thrown things for a loop, and they've created extreme market volatility. So it's important to keep your eyes long term, as we've illustrated, time and time again today. But it's also very important to remain diversified in a portfolio. Something that we get the question all the time when times are good. Oh, well, why don't we just invest in the S&P? and we're seeing it right now. We are certainly still believers long term in the S&P and our large cap domestic companies, carrying us moving forward. But we can't just put all our eggs in one basket. That would simply just not be responsible on our end. So we've diversified your portfolios in order to, withstand moments like this. And it's not to say you're not going to feel it, because of course you're feeling it, but we do spread you out. And it's very important to not, concentrate things too heavily in one area for exactly reasons like we're seeing today. So as we've shown this whole time, right? There have been negative headlines throughout history. There have been negative world events that, have made things seem like, we had said the end of the world. There are things that you are able to control, and there are things that you're not able to control. There's things that Mark and I can control and we cannot control. We can't control the markets. They're going to move as, they see fit. They're going to move on news. They're going to move fast. We saw on Monday, there was a fake report that came out about, a pause, and we saw the market spike and drop within a half an hour. It was wild to watch. But there are things that you can control. You can control your income, what's coming through the door. You can control how you're spending that dollar that's coming through the door. What we're talking about is your cash flow situation. You can control how much you will have coming in and how much you can reasonably expect to spend. If cash flow is becoming a concern for you, if your worry is based on right now things are tight and I need to figure out what to do here. I know it's best to stay put, but I really need to come up with some sort of solution here. Well, that's what Mark and I are here to do. We want you reaching out. We want to be talking about those things. Sure, these charts and these graphs, and it's great, and we can say slow and steady and just kind of head down and we'll be okay. But life happens and these things are real. These events can mean different things for different folks. So if you are feeling a concern on that level, talk to us, because that's what we're here for. We want to find solutions. That goes back to investing consistently. There are certain folks that might say, hey, this is an opportunity. There's a downturn. We haven't had one of these in a long time. Maybe, the term, if there's dry powder, we can put that to work. That could be an option for some folks, lump sum investing. Others might say, well, I'd like to dollar cost average my way back in. Or they might say, you know what, I'm staying put and I'm just going to keep my head down and that's it. It's a consistent process. That's all we're looking for. So I think what's a big bullet point here is on the bottom is to become a person that can thrive in any economy, meaning, your portfolio, your finances can do well in any economy. It's about being diversified. It's about being disciplined to a process. And what that process is unique to everyone. And it's our job to, show you our thoughts and our beliefs and work with you in how you're feeling. So that's really our takeaway from this. There's things you can control. There's things you can't. So what are we doing to, in light of all this? I can turn it back to Mark.
We made adjustments to our core ETF portfolios on 2/19. On 2/18, the markets hit an all-time high. So, everyone's going to have a different portfolio, and keep that in mind. We have hundreds and hundreds of different accounts. But the broad theory was to take money out of equities at a high point and place it back into bonds to rebalance the accounts. If you're in an all equity portfolio, well, hopefully you're younger, you got a long time to go and you shouldn't be that worried anyway, but you're still in all equities, right? To those who are in more balanced structures, we actually took really good advantage of the markets being priced near that high point. Again, just a day after. A little bit of that's luck, right? It's there's no perfect timing with these kind of things, but we did take the opportunity to de-risk the portfolio as we knew that there could be some more information that came out. With that being said, we're starting to get to a period where earnings multiples and prices are looking cheap. The market can certainly continue to go down from here, and we are evaluating the news as quickly as it's pouring out. It's a little bit like the fire hose method. But right around now is where we're actually starting to look for opportunities given the dislocation. If you think about, even just a 60-40 allocation, market down 10%, now we're 50-50. Fixed income has actually tended to fare rather well over this period. It's not a terrible time to bring ourselves back up to par at a discount to the equity level. So we don't have any next moves cemented today, right at this point, but just know that we are paying attention to these things in the back end and we're looking for the opportunities as they arise given the dislocations.
So we really want to thank everyone that was able to join today. Whoever was able to dial in, that's awesome. We are recording this, so we will be sending it out as well. We really do hope to make this a more common occurrence that we're doing these types of market update calls and update calls in general, as we think they're important. So if you are feeling uncertain, if you're feeling uneasy, if there are things that you need to discuss, that's really what we are here for, right? So this call isn't meant to be like everyone should be fine, we're okay now. This is more meant to be, this is our long-term view. As I've said 100 times today, everyone's situation is unique and different, and we're here to answer your questions. So we really appreciate you all. We hope that this was informative and maybe help to calm some nerves a little bit. And beyond that, we always appreciate you as our clients, and hope you have a great weekend.
Yeah, thank you, everyone. Please do reach out if you have any personal and direct questions. Thank you again for your time. We're really grateful.
Thanks.